Hello, everybody. This is Ravi. Welcome to yet another episode of PropTech Showcase Disrupt. In this segment, we pick exciting new products from all over the globe that are disrupting the real estate industry. We discuss the value proposition with the founders and, if possible, do a deep dive demo. Today, we have one such product, HelloData.ai, which uses AI to identify the most similar rent and expense comps for any size apartment building, then analyzes them every day to recommend the pricing, value adds, and operational improvements that maximizes your NOI. Hello Data's national data pipeline includes daily rent and availability updates on over 2 million multifamily properties nationwide, and they offer a series of APIs to deliver rent comps, expense benchmarks, and rent pricing recommendations in any market. As you can see, I read out their description from their website, but here we are joined by the founder, Marc Rutzen, who is going to break that up for us and help us understand what Hello Data is up to. Mark, welcome to PropTech Showcase Disrupt. How are you doing today?
I'm good. Thanks for having me.
Mark, since this is Disrupt and we handpick PropTech products and startups that are actually disrupting the industry, and you're onto something here, why don't we start with the problem that you are solving, Hello Data is trying to solve in the industry, and the reason for your existence?
Yeah, so the simplest way to state the problem is the way we price multifamily units is very, very inefficient. It's broken in a lot of ways. People determine subjectively what comps are most comparable. They navigate to property websites. They try to download active listings and copy and paste into Excel and do a ton of analysis just to come up with market rents at the end of the day. Whether you're an asset manager trying to do it to price your units every day, or you're an acquisitions team that is trying to look at a deal and evaluate whether you want to move forward, it's a very inefficient process to go through that. So what we've done is we use AI to actually determine what are statistically the most relevant comps for any property in any market. So there's only multifamily. So you put in an address, it's going to tell you what are statistically the most relevant comps, looking at it the way an investor does. So accounting for things like year built, number of units, average square footage of the units, but also looking at it from a tenant's perspective. So we analyze the listing photos in real time using computer vision, extract the condition, quality, and the style of the imagery. And we use that as a parameter in our comps model to deliver the absolute best comps. And the results are great on the front end to get that comp set and know that these are the most relevant. But then we go further by digging in to analyze their pricing, where they've actually closed in the past. So not the listing price. The listing price could be, it goes up, it goes down, especially if they're using revenue management. But where did that unit leave the market? What was the last price at which it closed? Because we find that comparing with our customers, their rent rolls open on one screen and our data on the other. When we capture the last price before a unit is removed from the market, that ends up being spot on with the rent that's on their actual rent roll. And so by using that closed pricing, we're able to analyze recent closings in the market, just like an appraiser would, and recommend rents for specific units in multifamily properties. So that's the big component of it, is solving that pricing problem and doing it in a way that matches with what everyone understands about real estate. You have to look at comparable things that closed recently to recommend pricing. And I feel like that getting to comparable things that closed recently is a huge problem to solve. And we're doing it because the recent advancements in AI.
So how has it been traditionally done so far? What is the status quo, and what's your differentiation there?
Yeah, so right now people, so they either use something like YieldStar or LRO to price units, which the complaints we've heard there are it's black box. They don't know why the pricing is moving up or down. And it doesn't work in tertiary markets or for properties that are too small, right? So if you're under 100 or so units, there's not enough supply and demand data at your property to really drive a pricing model. So there are a lot of drawbacks to that approach, and people are looking for something transparent that they could understand and explain. If you're a manager trying to set pricing, you need to have that conversation with your owner and explain why are we setting pricing in this way. And the existing models don't provide a ton of transparency to help you do that. The alternative to that is you go to property websites and cobble together data. You go to listing sites and try to download as much as you can, and then put it into Excel and calculate some averages and try to make a subjective judgment on price. And there are tools for that, like CoStar, obviously people use a lot. Problem is they don't get the granularity and the accuracy they want from existing sources. They want to dig in, because when you're pricing units, you have to dig into down to the unit level and understand how are your competitors actually pricing, especially when you're going to buy a property too, right? You need, if you're going to do a value add, for example, you're not going to just say, oh, I think the market rent's here. No, you have to understand this is what their classic units are getting, this is what their renovated units are getting, and look at the whole history of how those prices are trending. If you don't, you could end up losing a lot of money on a bad acquisition, right? So for both groups, both the asset managers and the acquisition teams, whether they're using existing pricing systems that are not very transparent and don't give them the granularity they need, or they're using existing data sources that just give you averages from the calls they made last month, versus letting you dig into the detail and see where things are actually priced, there's a gap, right? And that's a gap that we're solving for both acquisitions teams and the asset managers.
Excellent. Would you be showing us a demo to delve deeper on how it works?
Oh, absolutely. So the way this works, any property that we have in our database, whether it's a bigger property or smaller, any market across the U.S., doesn't matter, because we do have about 2 million properties in the database. You just search the address or property name, and it's going to come up. And right off the bat, we're going to show you things like year built, number of units, stories, and the high-level mix of market rents by bed count over here. But the big differentiator for us, when we show these prices, this is not what they are asking today. This is where they actually closed, right? So the last price at which those units were listed and they get removed from the market, the price on the day they were removed, we found, is within $5 of what's on the actual rent rolls, right? And that's a game changer, because it's the closest thing you can get to having actual pricing for your competitors without owning the property. Right, spot on. We've spot checked this with dozens of clients. Their rent rolls on one screen, our data on the other. Cross check the pricing, it's spot on. And at most, it's off by like $5 to $10. Right, so that's a huge differentiator. The big one for sourcing comps is our quality score. And so what we do is we comb through, as we're collecting data from property websites and several different listing sites every day. We analyze with our computer vision algorithm the listing photos to determine the condition and quality of each room and common area. And then we compile that into an overall score for the building. And what that does is it powers a big portion of our comps model. So when I press this suggest comps button in the lower right here, it's actually going to go out and find everything that is statistically most similar to the subject. Yep. So it goes out into the market and finds things that are similar in terms of their level of finish quality, but also several attributes, things that real estate people intuitively understand are important, like the market. For the market, we cluster census tracts with similar people and properties around each property. We kind of merge the market data up into the property and use it to identify properties that are in markets with similar properties and similar people. So say you're in a downtown area like Chicago, and there's a few blocks that are very different from the next block. Well, our algorithm will actually skip over the blocks that are very different in terms of the people and properties, and find the other Class A property that's a few blocks over, right? Because it's dynamic based on that market data. Distance here, what we do, it's sized dynamically based on the magnitude of distance similarity is sized based on what type of market you're in and the density. So downtown areas like this, you get penalized quite a bit by going even a block away. This property is like less than a quarter mile from the subject. You go into the suburbs, you can go miles away before you find the next relevant comp. And so distance is completely dynamic based on the density of the market. Of course, we take into account the number of units, the vintage, and the number of stories, things that comparable property detection algorithms do take into account. I consider this the investor side. This data all of this stuff is really the investor side of the equation. And this stuff is really the tenant side, right? What do the finishes look like? What amenities does it have? Because honestly, when a resident decides where to live, they're looking at location, then price, then how do the listing photos look? Do I actually want to schedule a showing?
Right.
So all of that we use to surface the 10 most relevant comps. We also have the ability to look at value add comps, right? This is a newer thing we added that's going to look at properties that are one standard deviation up in terms of condition, quality, and amenitization, and recommend those so you can do your value add analysis. Like I said, we cater to acquisition groups and asset managers, and the acquisition groups are very often considering a value add, so it helps to be able to do that. I'll just generate the report here and save, and then we'll dig in, see a little bit more of the UI. So like I mentioned, big differentiator, we distinguish between active versus closed listings, and we allow you to select only closed and see where have things closed over the last 90 days. Here's at the bed count level, right? So it gets more granular as you go down the page. I'll show you in a sec. But right off the bat, you'll see this too. We're analyzing the specials text from property websites and picking out the dates over which concessions were posted and the equivalent number of free months or one-time discount or recurring dollars off or waived application or admin fees. There are about 12 different attributes we use AI to pick out of the text automatically and apply so that you can calculate effective rents. Because we're taking into account when each unit was removed from the market and the concessions that were in place at the time it was removed. So that's a game changer because if you were to go do some of this analysis by hand, like go to the property website, even if you went every day, it would be a ton of work to capture every single special they post. Sometimes these properties post new concessions every single day, and it changes, right? And it's tough. Like imagine you didn't catch it on the 20th, so you missed it, and the units that closed during that short time frame got 2 months off, 2 months free rent, right? That's huge in terms of what they're actually getting in market rent. And so we help people catch that by surveying every single day, the rents and the concessions. We're able to help people catch that. The other thing is, we just added this recently, because we're analyzing this data daily, we see how frequently prices are changing. And we could tell from the frequency of price changes, if they're using revenue management, how often they're changing their prices. So how often does one price stay at one level before changing to the next?
Nice.
What's the delta between when it was first listed and when it's removed from the market, which sometimes can be pretty large. And depending on when you go to look at the property website, you may catch it on a high day and think the market rents are a couple $100 higher than what they actually are.
Right.
We help show in reality, the price started here, this is what they were asking, and it ended here. To me, I think of it like this. In single family, if some guy decides to list his house for $1 million, no appraiser in their right mind, no broker, no investor would just say, "Oh, it must be worth $1 million. He listed it for $1 million. That's the price." Well, we do that every day in multifamily. Going to property websites. Oh, those are the asking rents. Okay, that must be the market. The market is where they close, and that's what we capture with our platform.
Nice.
So as you go down the page, it gets more granular. Here you've got the average rents by unit type. So I can filter to any specific unit type by beds and baths and see how many listings were posted over the time frame selected, how many are still available today, what's the average time on market from the first time a listing appears to when it is removed, and then what are the average market and effective rents. And I could do this for all listings, just closed listings. I could do it over any time frame. So if I want to look at the last 60 days, 90 days, if I want to look at, just the month of July and what happened in July, I can look at that, right? We give the flexibility to look at trends over different time frames and for different unit types.
Nice.
As we scroll down, this is kind of the same data in the table above, but in just a bar chart format. So it makes it easy to read and to see that differential between the market rent and the effective, accounting for concessions. And then the historical rent trends. People love this because it goes all the way back to June. And when we started collecting data, when we really launched the platform. And you can look at trends over the entire, history that we have for these properties.
Right.
But the feedback was, and we've addressed it, and I'll show you in a second how we did. The feedback was, well, I don't know if during this time, maybe these were the not so great units in the building, although I'd argue at over $4 a square foot, probably everything is a pretty great unit in the building. But, if you're looking here, which listings make up this average? That was what people wanted to know. On these days, this could be the nicest units in the property, and down here could be the less ideal. Maybe they have a glorious view of the building next door versus a view of the skyline. So to that feedback, we added this unit availability table. Now, what this does for the subject property and for every one of its comps, we capture every single unit that hit the market, the day it entered the market, the day it left, and the changes in price among that or over that time period. And I'll pick one here where you can see a little bit more. So here, the way this is working, so we capture the first time this particular unit, studio unit number 2204, hit the market 6:30. Price fluctuated. It went down, spiked up a little bit, spiked again. And then at this point, there was a half-month free rent concession between these dates. On the 19th, they simultaneously raised the price to $23.60, and they offered a full free month. So effectively, the rent dropped down, right? And because we captured the last day that these units appear on the market, we can actually show you what the final price is, what the real market rent, accounting for any concessions that were present, was for this particular unit. And we do this for every single one of the units in the subject property and all its comps. Like if you're operating an asset and you want to dig in and see what have my competitors done with pricing, well, you might catch it if you go to the property website. You might catch it on this day and think market rent is $33.17. Right. But where it closed, $31.95, and that's a substantial difference. That's very dependent on when you go to the property website and check that data. And so by catching it every day, we can tell you how those prices changed over time and ultimately where it closed, which is the most important value for determining market rents.
Excellent.
As I scroll down here, we use that data on what has closed recently, and we determine where you should price your units based on recent closings. So you see the off-market dates here, closings in the past 30 days for the subject property and other units in the property itself, and from its closest comps. We're doing similarity down to the floor plan level here, determining how similar is each floor plan that was listed, when did it close, and where did it close, accounting for concessions that were in place. So the last effective rent. And by using that, we're actually, this is not like some advanced machine learning right here. We're trying to make it very simple for people to understand. The last effective rent, where it closed, less any concessions that were in place, we're just doing a weighted average. Take what closed on a per square foot basis and what closed on a market rent basis, weight them evenly by similarity, and use it to predict what the rent should be today. And So we're not trying to say like you should price it here and then you should put this concession on it. We're saying this is where things are actually closing, accounting for concessions. So this
Mm.
is where you should price to really be in line with the market. We do that for every actively listed unit type for the subject property. So it's, this is our first pass at a response to existing revenue management systems and their limitations. We make it a purely market-driven revenue management system that's very intuitive and easy for people to understand, and does it for every unit in the property all at once. We show the amenities and finishes. So this is the stuff that we extract with the computer vision algorithm. So we're rating every room type among the comps. You could easily, filter or sort here and see where you sit relative to the competition. These are high-end properties, so there's not a huge delta, but sometimes, you can see if it's a good candidate for a value add by saying, oh, the kitchens are, 2 levels of quality under the kitchens from the comp set. Okay, maybe we need to renovate our kitchens, right? It makes it pretty straightforward. We accelerate people's quarterly amenity surveys because we track about 200 different building and unit level amenities, including things like which utilities are included, the open floor plans, like many different amenities within the units and in the common areas. So there's a lot that you can add here to analyze in depth. We track the fees, so you can see if you're an operator, are you leaving money on the table? Are your comps adjusting their fees upward? And maybe you can too. And if you're an acquisitions team, was the current owner leaving money on the table? Maybe they're not charging the full level of fees that they could. So we make that pretty easy to analyze here. And then finally, we wrap it all together in one, essentially year one operating statement for the property.
Nice.
And what we do here, very, very innovative approach. We take everything that we have seen close over the entire time frame for which we have data, in this case going back to June. We take those closing prices. We know that in this building, maybe we have 30% of the units of the 505 units represented from these closings. So we take that number, we scale it up by dividing by the percent of the building that we've covered, that we have data for, and we scale it up to an estimate of GPR for the building itself. Then for the per unit and percent of GPR and EGI benchmarks, we actually have expense comps, 25,000 real property financial statements across the US, covering every single market, that we use to train a model that predicts every individual line item based on how other properties are operating in the market. So similar in terms of year built, number of units, physical attributes, location. We source essentially the top basket of comps. In this case, we use around 10 and look at their operations and build a model to explain how are all of these line items, how should all of these line items be or look based on the market, right? So how should you perform relative to the market? Are you doing a good job or a bad job? Well, you can quickly see by looking at these line items, if you're in line or not in line. And we try to be very transparent in everything we do. So we show here what are the factors that are bringing down the utility costs. So it's a newer building, more energy efficient construction. It makes sense that the year built brings down the utility costs. The quality being higher, less utility costs if you got a higher quality building on average. Having a large number of units brings it up, but just a little bit. And then the GPR per unit being, a higher end building is bringing it up because this building earns quite a bit of income, being downtown Chicago. So, those explanations behind each line item just give the context. The kicker with this, why it's so impactful, is because if you were to cut out all of my talking, everything we just did here took less than a minute. Right? We got to a full underwriting of year one operations in under a minute. Now, you could say I would underwrite it differently. You could say, man, those aren't the line items. That's not the chart of accounts I would use. But we did get to the most important things, GPR, EGI, total OPEX, and NOI in seconds.
Hmm.
When we've measured this against people's operating statements,
Right.
we'll be off on EGI. Like say it's a 10 million EGI. I've done this like several times in demos where I had someone pull up their operating statement and compare it to our analysis.
Right.
On a 10 million EGI, we'll be off by 20K.
Hmm.
20 grand off on a 10 million EGI for property we've never seen before anywhere in the US. And then for operating expenses, I just did a demo last week where they were underwriting this deal in Vegas, and they looked at their underwriting compared to what we put together in a second, and we were off on total OPEX and NOI by less than 100 grand.
Wow.
This was like a 300 unit property, so a big deal, and to be off by such a small margin when these people are professional real estate investors, they analyze these deals for a living, and we did it with machine learning very, very close to what they produce in seconds. You can see the power of the model, and we're only just getting started with this. I think it's going to be a game changer for analysis. It's going to change the way people look at comparability and pricing, but it's also going to streamline and accelerate deal flow for a lot of acquisitions groups across the US.
What is the standard margin for underwriting usually? What percentage it is?
What do you mean standard? The standard margin?
I mean, I'm sure there are underwriters who also underwrite. Since you are so accurate, is there a standard deviation that is acceptable?
It's so our error now on this is under 10%, but I think there's an upper limit to where you can go because operators are very different. REITs are going to operate very differently from private equity groups, very differently from mom and pop. The line items that they choose, the charts of accounts they choose are different. The items, the costs they incur are very different. So there's probably more than 10% variance among individual operators. But what we do is we get you the average based on everything that is similar in terms of your built number of units and composition of the building in the market, and weight those data points most heavily.
Excellent. Very comprehensive, Marc. So much of power in hands. Is this a kind of granularity an exception? Like the kind of granular information that you are providing, is this not the norm? I'm supposing this is not all applications provide that much granular information in the hands of the users. No.
No. That's the main feedback we've been getting is that people love that it's real time. It's very granular, and the proof point is everyone puts in their property, and when they see the numbers match up with what they have on the rent roll, they trust it. It is almost the same way every time. I try to run other people's deals rather than the sample deal when I go through demos, because it helps them understand, like, okay, how can this add value in my specific case for my specific deal?
Got it. And how does one do you offer trial to your prospects? How does this work out? How could people test it out?
We are not fans of the whole you're locked in for a year as soon as you want to try it out, you have to sign a full 1-year contract. No, so what we do, we offer a 7-day free trial on our site. So you sign up, it walks you through a demo, kind of like what I just did, but on kind of a walk me type walkthrough, and then it ends on the trial. So then you sign up, and then you got it for 7 days. You can run as many deals as you want, get pricing recommendations for whatever you want, download as much data in our Excel export as you want. We try to make it really easy to use, and we have a very good conversion rate from people who do the trial. It's like 90% plus are actually signing up and keeping it.
Got it. Excellent, Marc. Thank you for your time, and all the best for HelloData.
Absolutely. Thanks for having me, and appreciate being on the show.
See you around, Marc. Bye-bye.